let's see, some books that I just finished. We podcasted I think all three of these, but in fact I know we did. Chain Reactions by Lucy Jane Santos. History of Uranium. The main thing I drew out of the book, because it's like, uranium, and she goes all the way back to what they call pitch blende, which is like the kind of the origins of uranium that the Germans were finding in these mining towns where like you find gold in this pitch blende. And so what they do, they just took the gold out. And if you got too much pitch blende, you knew the gold was gone. And so you go from that, its original formation of like how we got these materials, and I'll call these base materials, if you will, to it's like, all right, when you figure out that you can use radium, the hucksters and the marketers all show up. And it's like if you when you're reading her book, you can hear like AI ringing in your ears because, like the old joke is there might be some truth to that rumor. There might be also a lot of lies. And I think you have to be very careful. It's like you go and look at a corporate issuer's IR deck, and if you didn't have AI in your corporate information or in your risk disclosures, it means you probably didn't have a pulse, and it just shows you whether it's real or not isn't dependent on the occurrence of it. That whether it's real or not is only dependent by time. Everyone wants their boat to float on the AI river. Is Correct. What you're getting at. So the other one that we read, and I just I think we brought this up in our discussion. Connor joined me for it. Was the Caesar's Palace Coup by Sajid and Max. We are watching right now what is going on with Milrose and Lennar. Mm-hmm. Okay, and why it was such a fun book to read is because it actually reminds me also of another book. And I got to meet. I think I got to meet, or I got to ask a question, Joel Greenblatt. Maybe he wouldn't say he met me. That's probably giving me too much credit. But I got to meet Joel, and the other book that comes to mind is How to Be a Stock Market Genius. Okay, and in that book, he talks about when the hotels separated the PropCo and the OpCo out. And so, like, I think it was in college at the time I read that. So you're just always kind of like, huh, that's interesting. But at the time, you're like, that was profitable from a stock perspective. But as an analyst, you're thinking like, what actually made that so profitable? Okay. And what it was is that it caused the investors to look at the same business separately, differently, which was this. A business that is capital intensive, that produces lower returns by nature, will get lower multiples. There's just nothing shocking about that. That's a matter-of-fact statement. Just like if I said a business that needs less capital, that produces higher returns, gets a higher multiple. And the weird part to humans is even though those can sit in the same corporate structure, we actually have trouble understanding them together because ultimately our concern is that the capital-intensive part will affect the less capital-intensive part, okay? So that's what I think the idea is. But then you go to the Caesar's Palace School. Well, not only is that rolled out in the hotel world, but the most natural place is businesses that have a lot of hotel rooms, casinos, right? But any real estate asset, we've talked a lot about, say, U-Haul, who has real estate assets but sits in a C corp, versus all their peers sit in a REIT structure. All real estate, which is ultimately asset-backed lending, is now sitting in a PropCo REIT structure, is how we think about it. So it was such a refreshing book to think about, okay, let's just do a case study on the past history of businesses that broke out the PropCo and OpCo. And what always happened is the cost of capital for the property company went down, okay? Which means obviously the cost of finance, it went down, which marginally helps returns there and also would help multiples. But more importantly, there's just very little capital needed in the operating company there forward. And that's why, like in the hotel business, it's become more of a royalty model because you're collecting a royalty for your brand. And it was so refreshing because as we know, as we watch Milrose kick out right now, it's like if I call up the Wall Street sell-side analyst and say, hey, you covered the housing stocks, what are you going to do with this Milrose? They're like, I don't have a clue. It's a REIT. And it's tiny. Well, relative to those market caps. But the question, like I would think, is like, well, how tiny is it relative to the book, and what are the returns of the business and things like that? And so I find it funny that people can study an industry as integrally as that And then when it comes to understanding the disaggregation and the capital intensivity inside the industry, they're like, I'm punting to the REIT analyst.
Yeah.
And it's like, well, the question is, do you really understand the business if you're punting to the REIT analyst?
Well, which just reminds me of something I've been talking a lot about lately, because the stocks have been punished primarily because of their success. Our large home builders are unfragmenting a fragmented industry.
Yeah.
So the more people focus on the temporary problems in the industry, those temporary problems work in favor of the unfragmenting.
Yeah, I agree.
It works in the favor of the wide moat, strong balance sheet.
Correct, but it's your point. It never let a good crisis go to waste.
Yeah, it's exactly what you'd want to have happen if by the end of 10 years from now, you've had 3 or 4 companies completely conquer the entire industry.
So let's use it. Like if I ask you in hotels, how many brands are there? How many mega brands are there?
Maybe 4 or 5.
4 or 5. That's what I'd say.
Yeah.
And then if I say, hey, casinos, how many mega brands are there?
There's probably 20
I say there's like 6
or 6.
Something online.
Oh, mega brands. Yeah.
Yeah. So because you have like Caesars, you have MGM, but there's not a lot, to your point. And then it's like, okay, if that's the guidebook, and by how many of those groups sit private? Okay. So it's like, we're all going to go to lit markets in that industry, and which means we're going to take private players, disaggregate them, bring them forward. And again, I think that's what, because as Caesar's Palace is getting rolled up, they continue to swallow more assets. That's the nature of the beast. The other book is Fortune's Bazaar, which we did a podcast on with Vadi in England. I would just say this. It was interesting to think back to the history of Hong Kong. And then, like we've talked a lot about, sentimentally, it's very obvious that China is on the outs. It's a swear word in some respects. Very different than the 9 Politburo members in 2011 are going to figure out this world better than we were.
Brick trade.
Things don't change overnight, but they do change over time. But really the history of Hong Kong is the families that are in business. And so as we watch the Li Ka-shing entities of the world sell a port in Panama to BlackRock and have them get chastised by the Politburo and the Communist Party, while we watch, the tycoons of Hong Kong really get hung out to dry by the government. It's just a very interesting time. I think it says something that the strength of those families in Hong Kong are really the core of Hong Kong. And if they are not in strength, neither will Hong Kong ultimately. Let's pivot. What are you currently reading, Bill?
Well, I'm reading a very fascinating book called Inside Money, which is the story of Alex Brown and Sons.
Yeah.
And obviously, as you can see from this podcast, we already have a multi-generational business ourselves in the investment business. And so this is one of the great multi-generational investment businesses. So that part of it automatically makes it interesting from our side. But it's also an incredible history lesson.
Yeah.
Because, for example, they funded the Baltimore and Ohio Railroad, which is really the first significant railroad in the United States.
The same one that's in Monopoly.
Yeah, the same one that's in Monopoly, and then triggered, and I just love this kind of thing. It triggered the movement of the United States government to decide it was a really good idea to push the railroad system west, so in 1836, a general by the name of Winfield Scott, yes, that's Winfield Scottsdale, if anybody's wondering, General Winfield Scott appointed a guy by the name of Isaac Stevens to head the U.S. Army Corps of Engineers. Now, when you grew up on the Columbia River near the dams that are governed by the U.S. Army Corps of Engineers, you're very familiar with them. But his first job was to survey the Western railroads, which was triggered in the 1830s by Alex Brown and Sons funding the building of the B&O. So this all kicked in motion, and so he and his team were hired to survey the Western railroads. That means out to San Francisco, out to Portland, and out to Los Angeles. It was later that Sam Hill sent the railroad, the Great Northern, from Minnesota to Seattle, but that was way later.
Yeah.
We're talking 50 years later.
They also make me think of the old saying, "What in the Sam Hill?"
Yeah. So I am part way through the book. It's very enjoyable, enlightening.
It's very much a transatlantic history, but also an American history in a lot of respects.
Yeah, and of course I know part of the ending is that when Microsoft went public, they went public through Alex Brown and Sons out of Baltimore.
Yeah, but I don't think the book covers that because it only goes to 1960.
No, that's right.
They would need another 21 years.
But just think about that. That was ultimately, in that particular era, the most glamorous IPO ever. And of course, Alex Brown and Sons does no longer exist.
Well, it's part of Raymond James, but Alex Brown and Sons was considered a white-shoed firm at one time.
Yeah,
so
very
there was
much
a
so.
prestige to have Microsoft go public with them.
But of course, they had the stain of not being involved directly, but making an awful lot of money trading cotton that was made with slave labor. So
correct.
So you got that part of the book, and then I haven't got to the rest of it, but it should be fascinating.